You know, investing can feel like you're trying to solve a huge, complicated puzzle, but you've lost the picture on the box. Right? So many pieces, so many choices. Today we're going to look at one of the most popular ways to start putting those pieces together, the unit trust.
Does that sound familiar? That feeling of being a little overwhelmed? You want to grow your wealth, you know you probably should be investing, but the sheer number of options out there can be, well, paralyzing. Where do you even begin?
Well, that is the exact problem unit trusts were created to solve. They're built for people who want their money to work for them, but just don't have the time, or maybe the super deep expertise, to be tracking markets and managing a portfolio day in and day out.
So, here's what we're going to cover. We'll start with what a unit trust actually is, we'll meet the key players, see how the whole thing works, weigh the risks against the rewards, and then we'll wrap it all up with the final takeaway for you.
All right, let's dive right into the basics. What exactly is a unit trust? The easiest way to think about it is pooling your power. At its heart, it's pretty simple. It's an investment that takes money from lots of different investors, people who are all kind of aiming for the same financial goals, and puts it all into one big pot. Then, that collective pot of money is invested by pros into a whole range of things like stocks, bonds, and property.
And listen, this isn't some small niche idea. The industry has grown a lot. This shows you it's not just a tool for the experts anymore. It's become a really popular mainstream strategy for everyday people looking to build their wealth. And that's exactly why it's worth understanding.
So, how is all of this money managed and, more importantly, protected? Well, the whole system is built on teamwork. You can see here how the investor's money goes into a central fund, which is then managed and safeguarded. There are really three key parties working together to make this happen, and we're about to meet them right now.
So let's pull back the curtain and meet these key players. I like to think of them as the brains, the guardian, and of course, the most important one, you.
First up, the unit holder. And guess what? That's you. When you put money into a unit trust, you're buying units. Each unit is basically your little slice of the entire investment pie. And as an owner, you get your fair share of any returns that the fund makes.
Next, you've got the manager, or the management company. These guys are the brains of the whole operation. They're the ones who set up the fund, decide on its goals, and their expert fund managers make all those critical day-to-day decisions about what to buy, what to sell, and what to hold on to.
And finally, there's the trustee. Think of the trustee as the guardian of your money. Now, this is really important. They are a totally separate company from the manager. Their main job is to hold all the fund's assets and act like a watchdog, making sure the manager is playing by the rules and always acting in your best interest.
Okay, so now that we know who's who, let's pop the hood and look inside the engine room to see how you can actually make money from all this.
It pretty much boils down to two main ways. The first is growth. Simple enough. If the stuff the fund owns, like stocks or properties, goes up in value, then the price of your units goes up too. The second way is distribution. The fund might earn income from things like dividends from stocks or interest from bonds, and that income can then be paid out directly to you.
And there is a whole menu of funds to choose from, depending on what you're after. You've got equity funds, which aim for higher growth from stocks. You have bond funds, which are usually for more stable income. There are property trusts for investing in real estate, and even Islamic funds that are designed to follow Sharia principles. Each one has a totally different strategy and risk level.
Now, you might also hear people throw around the terms open-end and closed-end. So what's the deal with that? It's really just about how you buy in. Most unit trusts are open-end, which just means the fund creates new units whenever a new investor comes along. A closed-end fund, on the other hand, has a fixed number of units. It launches with an IPO, and after that, you buy and sell them on the stock exchange, just like a regular company share.
Okay, but let's be real for a second. No investment is a sure thing, right? The most important thing is to understand both sides of the coin. So let's take a good, balanced look at the rewards and the risks that come with unit trusts.
Let's start with the good stuff, the rewards. And honestly, they're pretty compelling. First, you get instant diversification. Your money is spread across tons of different investments, which helps lower your risk. You get professional management. Experts are making the calls for you. They're accessible, often with really low minimums to get started. And they're liquid, which just means it's usually pretty easy to sell your units and get your cash.
But a smart investor always looks at the other side. So what are the risks? Well, the value of your units is tied to the market, so it can go down just as easily as it can go up. That's market volatility. The fund's performance also really depends on how good the fund manager is. That's called management risk. And finally, there are fees and expenses that you have to pay, and those costs will of course eat into your final return.
So after all that, how they work, who the players are, the pros and the cons, what's the bottom line here? How do you decide if a unit trust is the right piece for your financial puzzle?
At the end of the day, it really comes down to this. Unit trusts are a powerful way to get professionally managed diversification. They knock down the old barriers to investing, making a properly balanced portfolio something that's truly accessible, even if you don't have a ton of cash or time to get started.
So the big question I'll leave you with is a personal one. When you think about your own financial goals, your timeline, and how you feel about risk, does having professional managers and instant diversification outweigh the cost of the fees? Answering that question for yourself, well, that's the first real step to solving your own investing puzzle.